Module 5, Factors Influencing the P/E Ratio. Several key factors influence a company's P/E ratio, reflecting the market's perception of the company's valuation and growth prospects. Understanding these factors is essential when analyzing and interpreting a company's P/E ratio. Here are the key factors that influence a company's P/E ratio. Earnings growth. Companies with higher earnings growth rates tend to have higher P/E ratios. Strong and consistent earnings growth indicates a company's ability to generate higher future profits, making investors willing to pay a premium for the stock. Industry and sector dynamics. Different industries and sectors have varying growth rates, risk profiles, and profitability levels. Market participants assess a company's P/E ratio relative to its industry peers to understand its valuation in the context of the specific industry or sector. Industries with high growth potential or innovative technologies often command higher P/E ratios. Competitive position and market share. A company's competitive position and market share impact its P/E ratio. Companies with dominant market positions, strong brand recognition, or unique competitive advantages may have higher P/E ratios as investors perceive them to have better growth prospects and a higher ability to generate future earnings. Risk and uncertainty. Companies operating in highly uncertain or volatile industries may have lower P/E ratios due to increased risk perceptions. Cyclical industries, emerging markets, or companies facing regulatory, legal, or geopolitical uncertainties often trade at lower P/E ratios as investors demand a risk premium. Dividend policy. Companies that distribute a significant portion of their earnings as dividends may have lower P/E ratios. This is because investors may perceive these companies as more stable and mature, emphasizing income generation rather than growth potential. Interest rates and macro environment. Interest rates and overall market conditions influence P/E ratios. In a low-interest rate environment or during periods of market optimism, investors tend to pay higher multiples for stocks, resulting in higher P/E ratios. Conversely, during economic downturns or rising interest rates, P/E ratios may decrease as investors become more risk-averse. Investor sentiment, market sentiment and investor behavior impact P/E ratios. Positive investor sentiment, driven by bullish market conditions or favorable news about a company, can lead to higher P/E ratios. Conversely, negative sentiment or bearish market conditions can depress P/E ratios. Company-specific factors. Company-specific factors, such as financial health, management quality, growth prospects, product innovation, competitive advantages, and corporate governance, play a significant role in determining the P/E ratio. Strong company fundamentals and positive news can drive higher P/E ratios. While negative developments can lead to lower ratios, it's important to note that these factors interact and influence each other, and their impact on a company's P/E ratio may vary based on the specific circumstances. A comprehensive analysis of the company's fundamentals, industry dynamics, growth prospects, and qualitative factors is necessary to fully understand the drivers behind its P/E ratio. Earnings growth. Earnings growth is a significant factor influencing the P/E ratio. Companies that demonstrate strong and consistent earnings growth are often rewarded with higher P/E ratios. When a company's earnings are growing, investors anticipate higher future profitability, leading them to be willing to pay a higher price for each unit of earnings. As a result, the P/E ratio increases. Conversely, if a company experiences declining or stagnant earnings, the P/E ratio may decrease as investors become less optimistic about future earnings prospects. Market conditions. Market conditions play a crucial role in determining P/E ratios. During periods of bullish market sentiment, when investors are generally optimistic and willing to take on more risk, P/E ratios tend to be higher. This is because investors are more inclined to pay a premium for stocks, expecting future growth and higher earnings. In contrast, during bearish market conditions or periods of increased risk aversion, P/E ratios may be lower as investors become more cautious, leading to a decrease in stock prices and P/E ratios. Industry dynamics. Industry dynamics significantly impact P/E ratios. Different industries have varying growth rates, risk profiles, and levels of profitability, leading to divergent P/E ratios. Industries with high growth potential, such as technology or biotechnology, often have higher P/E ratios as investors expect above-average earnings growth. On the other hand, mature or cyclical industries may have lower P/E ratios due to lower growth expectations or higher perceived risks. Investors compare a company's P/E ratio to its industry peers to evaluate its relative valuation within the industry. Additionally, industry-specific factors like regulatory changes, technological disruptions, or market trends can influence P/E ratios within an industry. Positive industry developments, such as increased demand or favorable market conditions, can drive up P/E ratios as investors expect companies within the industry to benefit. Conversely, negative industry developments or challenges can lead to lower P/E ratios as investors price in the risks associated with the industry. It's important to note that while earnings growth, market conditions, and industry dynamics influence P/E ratios, they do not act in isolation. These factors interact and can have a combined impact on the P/E ratio. It's crucial to consider all these factors holistically, along with other relevant factors. When analyzing and interpreting a company's P/E ratio, changes in earnings growth, market conditions, and industry dynamics can have a significant impact on the valuation and perception of a company. Here's how these factors can affect the valuation and perception of a company. Earnings growth. Positive earnings growth. Strong and consistent earnings growth can increase the valuation of a company. Higher earnings indicate increased profitability and future cash flows, leading investors to assign a higher value to the company's stock. Positive earnings growth can enhance the perception of the company's ability to generate future returns and attract more investors. Declining or stagnant earnings. If a company experiences declining or stagnant earnings, its valuation may be negatively affected. Investors may become cautious or skeptical about the company's future prospects, leading to a decrease in the company's valuation. Negative earnings growth can erode investor confidence and result in a more pessimistic perception of the company's potential. Market conditions. Bullish market conditions. During bullish market conditions, where investor sentiment is positive and there is an appetite for risk, the valuation of companies tends to increase. Favorable market conditions can lead to higher stock prices, reflecting the overall optimism in the market. Positive market conditions can also create a perception of favorable investment opportunities and attract more investors. Bearish market conditions. In bearish market conditions, characterized by negative sentiment and increased risk aversion, the valuation of companies may decrease. Investors may become more cautious, leading to lower stock prices and a more conservative perception of the company's prospects. Bearish market conditions can create challenges for companies seeking capital or favorable valuations. Industry dynamics. High-growth industries. Companies operating in high-growth industries, such as technology or renewable energy, often command higher valuations. Positive industry dynamics, such as expanding markets, disruptive technologies, or regulatory support, can enhance the perception of growth potential and drive up valuations. Investors may perceive these companies as having better opportunities for revenue growth and higher earnings, resulting in a more favorable perception. Challenged industries. Companies operating in industries facing challenges or experiencing slower growth may face lower valuations. Negative industry dynamics, such as regulatory hurdles, market saturation, or economic headwinds, can dampen investor sentiment and decrease valuations. The perception of limited growth potential or higher risks can result in a less favorable perception of companies operating in challenged industries. Changes in these factors can also impact the perception of a company's risk profile, competitive position, and future prospects. Investors and market participants reassess their expectations and adjust valuations accordingly. It's crucial to monitor these factors and understand how they can shape the overall perception and valuation of a company.